Good day, student. I welcome you to today's lesson. This is the second part of the lesson on the title Accounting for Joint Venture, Accounting for Joint Arrangement, Accounting for Joint Operation. So it is expected that before you attend today's lesson, you must have gone through the first lesson. So you must have digested all the principles involved in joint arrangement and all the explanations given well understood. So I welcome you. So we are going to be looking at 6 questions together. 6 questions. Question one, question two. Let me zoom it in so that it can get bigger. Question one, question two, question three, question four, question five, and question six. So it promises to be another fascinating time in class. All right, let's get started. Question number one. Entities A, B, C, and D each hold a 25% interest in entity J. Decisions in entity J need to be approved by a 75% vote of the parties. The question is ABC Limited jointly controlled? We want to establish whether there is joint control or not. And you remember from lesson one that we did say that for us to have a joint control, certain conditions must be fulfilled. Number one, all the parties involved must be carried along in decisions involved, decisions about to be taken. All the parties. So if three or two or one party can go ahead because he has majority, ownership interest in that entity and wants to make that decision, we cannot say that such an arrangement is a joint arrangement within the concept, within the principles, within the strictures of IFRS 11. So if we take a look at this question, you would see that each of the parties involved, party A, party B, party C, and party D, they have 25%. And their contractual agreement specifies that there must be at least 75%, 75% vote before any decisions can be taken. The question now is ABC Limited jointly controlled? So now 75%. If we combine A and B will have 50%. Decision cannot be taken. B and C, 50%. They can't go ahead and take any decision. The same also applies to C and D or other possible combinations of A, C, B, A, B, D, or whatever. So, but if we extend it to three entities coming together, will they meet up with that 75%? Yes. A, B, C can come together and they will have 75%. B, C, D can come together and they will have 75%. So A, C, D can come together and any other three combinations will give you that 75%. What that means is three entities can conveniently come together at the expense of the third entity. So it means that they can go ahead and take decisions in exclusion of one of the entities if three of them can successfully, come together and form what we can call quorum here. I hope you're following the class. So now I hope you see what I'm saying. So if three of them can come together, it means that they don't need the consent of the fourth person to take decision. And you remember, for there to be joint control, unanimity of consent of all the parties involved in the arrangement must be sought and obtained. So unanimity here is A, B, C, and D. So if A, B, C can come together and exclude D, or B, C, D come together and exclude A, then this means that there is no. If I'm to answer this question, I'll come here and say, okay, I hope you're following. I will say that there is no what? There is no evidence of joint control. there is no evidence of joint control in this business arrangement. In this business arrangement, no evidence of joint control in this business arrangement. And of course, if there is no evidence of joint control in this business arrangement, then therefore, there is no joint arrangement. Therefore, there is no joint arrangement. And once there is no joint arrangement, we cannot be talking of joint operations. So within the context, within the context of IFRS 11. So once there is no joint arrangement, there cannot be joint operations or joint venture. I hope we're clear. So here, no joint control, no joint control. That is the answer. I hope we're on the same page. So I quickly move on to the second one, which is question two. Question two. Question two. So question two goes thus. Two parties establish a separate legal entity in which each has 50% voting rights and equivalent power. 50% voting right, 50% voting right. Important, establish that over the investee relevant activities. The separate legal entity activities constitute a business, of course, as provided for by IFRS 3 business combination. Now, the contractual agreement, let me put this in red so that it can be different from the rest. So 50% of the voting right and equivalent power. So two parties, at least each one has 50, the other has 50. The separate legal entities activities constitute a business. Fine with that. Now, the contractual arrangement between the two parties specifies that at least 51% of the voting right, at least specifies, look at the contractual agreement. Contractual agreement is important. Okay? What does it specify? It specifies that there must be what? At least 51% voting right are required to make decisions about the separate legal entity. About the separate legal entity. And the question is there joint control overruns joint arrangement? Absolutely. Absolutely. And to answer this question, affirmatively, I would say that there is what? There is joint, uh, there is joint control because each party, there is joint control because each party has 50% and then they will need 51% to vote, to make any decision. 51% will be needed. So each party will need the other, and there are just two of them. It means unanimity, of consent of everybody must be sought before any decision can be taken. And once there is joint control, of course, you will expect that. Of course, you would expect that the there is joint. There is what? Joint arrangement. There is joint arrangement. So, and another thing I want us to really have this question is, as a separate entity. And once and the two, they establish what? A separate legal entity. You remember what does IFRS 11 says about, having a separate vehicle? Once there's a separate vehicle, what type of joint arrangement would this be? So, if you are to hold this question, what type of joint arrangement will it be? So, what type of joint arrangement will it be? The type of arrangement that will be is joint what? Operations. No. No, 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 no. It's not joint operation. It is joint venture. Other things being equal. That is after you must have considered the three other factors. Factor one is the legal form must specify that the parties involved have rights to the asset and obligations for the liabilities. Contractual, terms must also support that in addition to other relevant facts and circumstances. So I would say that this arrangement, this joint arrangement, that is after we have established that there is joint control. So you can extend that question. So this joint arrangement qualifies as joint what? Joint venture. So in the absence of other information. I hope you're following. See, there's nothing in IFRS 11, so taking it bit by bit, we're following. So, no question? Clear, good. So, very quickly, I'll move to question three. Question three, question three. So, I'll move to question three. So, question three goes thus. Shareholders A and B form a new joint arrangement J. New joint arrangement J. The entity J's articles of association, include a clause that states that all shareholders must unanimously agree. All shareholders must unanimously agree. They form a new arrangement. So the new arrangement is entity J is separate, abi? That makes it a joint venture. You agree? And because they must unanimously agree over relevant activities, means that it's joint control. Even before I'll get to what the question asks us to do. So no other agreement are entered into by the shareholders to manage the activities of J. Then the question now is the structure a joint arrangement? Is it a joint arrangement? Definitely. It's a joint arrangement. It's a joint arrangement because the structure is a joint arrangement. The following. So the structure is a joint arrangement. Is a joint arrangement based on the fact that unanimity unani, unanimity 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 of consent unanimity of consent of the shareholders unanimity of consent of the shareholders must must be sought and obtained. So if I'm to prep up this question, I say, okay, what type of joint arrangement is it? Of course, we agree it's a joint arrangement. What type of joint arrangement is it? This is a joint venture. With the form being, let me find it, with the form of JA. J is shortened for joint arrangement, so that we can follow it. JA form with the form of JA being a joint venture, because as a separate vehicle in joint venture. So of course, because as it was, because as a separate vehicle. So let's complete that sentence. Because there is a separate what? A separate structure, separate vehicle in line with IFRS what? 12. No. Cannot be 12. IFRS 11. IFRS 11. So I hope we are clear. So following is definitely a joint arrangement. So that entity J, entity J, entity J, J, entity J. Good. So move on to question 4. Question 4. So what does question 4 look like? Let's call up question 4. Question 4. Okay, good. Brilliant. We need this now. We'll come to question 5 later. Let's push it down. It's 4 that we need. Three parties establish a separate legal entity, entity Z, in which they have different shares of voting rights, different shares. Entity Z activities constitute as a separate, separate entity. Separate entity. Okay. Is it a joint venture? Is it a joint operation? Is it a joint arrangement? We never can tell. In which they have different shares of voting right. Entity activity constitute a business as defined in IFRS 3. The contractual arrangement entered into by the three parties specifies that at least 75% of the voting rights are required. 75% of the voting rights are required to make decisions. Of the voting rights are required to make decisions about the entity Z. So, what is the requirement? The question required is there joint control? Is there joint control? Is there joint control? Yes. Yes, there is joint control because we require at least 75%. 75%. And none of these parties, none of them can get 75%. So without, none of them can get 75%. So, and if A, if A, both are required to make decisions about Z. So if A, B are coming together, if A, B must come together, they can get 80%. A, B, they can get 80%. So BC will get 50%. So AB, a contractual agreement enter into by the three parties where at least 75% of the voting rights are required to make decisions about the entity Z relevant act. So 75% is the key word. So now 50 will not meet up with 75%. 50 plus 30, 80% exceeds 75%. Means A and B can come together. And if they can come together, it will be at the expense of what? Of C. So A and C can come together, but they will not match that 75%. The only possibility where they will meet that 75% is when A and B come together. And when they come together, they exceed 75%. So it means they can take decisions at the expense of C. And if they can do that, so what this implies is that, you know, there is no joint control. Although they have a separate entity, there is no joint control. And if there is no joint control, if there is no joint control, if there is no answer, so there is no joint control. Simple as that. There is no joint control. There is no joint control. And once there is no joint control, there is no joint arrangement because A and B can come together to meet 75%. So to meet 75%, and they will take decision. They will take decision at the expense of C. And all the parties must give their unanimous consent. Collectively, you can't leave any one of them before you can have a joint arrangement. I hope you're following. Good. So I hope with these four questions, you should be able to test out and identify whether there is joint control or not from question one to question two to question three, now to question four. Good. No joint control. So no joint control. Okay, so now move on to question five. How does question five look like? How does it look like? Some promise to be very interesting. Question five. Can you see? So question five. Abata PLC has a 48% share of a joint operation. They have made this one very clear to us that it's a joint operation. So we are looking at the accounting now, the accounting part beyond just identifying is there joint operation, is there joint control, is the structure a joint arrangement? You should be able to, be able to answer such questions at this level. So about the PLC has a 48% share of a joint operation, a natural gas station. So that is the vehicle. The following information relates to the joint arrangement activities. What are these information? Now, the natural gas station cost how much? 30 million to construct. 30 million to construct. And was completed on what date? 1st January 2018. His useful life is estimated at 15 years. His useful life is estimated at what? At 15 years. I hope you're following. Is estimated at 15 years. Is estimated at 15 years. That is the useful life. So illustration 2 now says that in the year, that's the direct cost. Sorry, additional information 2, not illustration 2. Additional direct cost of 44 million was sold for how much? Ah, no, this is not 44. Let's make this um, let's make this 60 million. So the direct cost of 44 million was sold for how much? 60 million. So additionally, we can make this one 3 million. So 3 million. If you follow. Additionally, the joint arrangement incurred operating cost of 3 million during the year. Asset, liabilities, revenue, and cost are apportioned on the basis of the shareholdings. Abata has only contributed and accounted for his share of the construction cost, paying how much? 14.4 million. What is the ownership interest of Abata? 48%. And what is the cost of that natural gas? 30 million. So let's confirm whether that 14.4 million is equivalent to 40% of 30 million. So we'll say 48% times 30 million. Oh, oh, that's 14.4 million. Good. That's the amount you paid. Why the other party or the other parties paid the balance. So the revenue and costs are receivable and payable by the other joint operator who settles amount outstanding with Abata after the year with Abata PLC. Abata PLC is completed. Abata PLC after the year ended 1st December 2018. So required. Show how Abata PLC would account for the above in his financial statement for the year ended 31st December 2018. That is the requirement. That's the requirement. So that is the requirement. So can you see? I want us to have at least a glance. Okay, right, brilliant. I think we captured it this way. Let me reduce it a little bit more. Okay, are we there? So, so how do we deal with this? Now, what we'll do is Abata will have to take his own share of the revenue. He will take his own share of it. And remember what IFRS 11 says about joint operation. You take your own share of assets, take your own share of liabilities, take your own share of incomes, and take your own share of what? Of expenses. So you take your own separate financial statement when you are preparing your consolidated financial statement. So that's exactly what we are going to do. So I'll come here and open Abata's book. So I'll open a book for Abata. Abata. So come here and say Abata PLC. Let me increase. Okay. Let's make this and increase zoom so that we can see. So let me increase it a little bit more. Or good, brilliant. So title there first about the PLC. Of course, it has to be a consolidated FS because Avatar 2 is operating on its own, just that he has investment in another entity. So consolidated statement of profit or loss, profit or loss. And what is the year? Let's get the year from here. 2018. 2018. No, 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 no. For year ended 31st December 2018. So items you have here, you have revenue, Also, that question that is revenue. So, and there is direct cost. Abi, I'll capture the direct cost here. I can see also there is operating cost, operating cost, operating cost. That direct cost captures more or less, cost of sales. So if there are other expenses, we'll capture those other expenses. If there's any, capture them. Other expenses, then you have profit. So this is how the statement will look like. Let me do it very well so that capture this, bring this one here. So our statement looks very, very, very good. Hope you're following. So please don't get lost. You want to go and you may want to go and take a sip of water. So I will continue. So okay, you following? Good. So I'll come here. All the figures are in millions. So I don't like working with large figures. So I will just make them relative. So I'll say naira. So all figures are in millions. Don't forget. It's very important to understand this. So I'm going to bring small figures here. Small figures. I will also do the same for statement of financial consolidated statement of financial position. Statement of financial position. I hope you're following. Good. Brilliant. One is not for the year, it's always as that. So don't make that mistake. It's always as at 31st December 2018. So the items you are likely going to see there, those items will be under current assets. Under current assets. So then I think we have another one under current liabilities, current liabilities, current assets, current liabilities, and it's like we have property, plant, and equipment also. Property, plant, and equipment. Brilliant. So let's lay out all the structures this way then. You'll make it so easy for us. Just be plugging in all the figures. If you need some water, you can go and get them while you leave me to attend to this weather. Okay, brilliant, brilliant. Oh, it's like we are getting ready. Okay, so let me leave some spaces here. Good. No, I know the space here is too much. Okay, I'll take this one up. So here, format goes, say assets. So all the assets will be like this. So put example here, current liabilities. Current liabilities will be under, so let me not make it this detail. So I hope you're very conversant with all the format of this line with IS1. So okay, so now let's go back. Let's go back. We start with consolidated. So come out to the question. 48%. What is the revenue there? 60% because it's a joint operation. But I will take his own share of the revenue, his own share of the expenses, his own share of assets, and his own share of liabilities. So pick the sales of how much? 60 million. This is the sales here. So sales of 60 million. So I'm going to take 48% of 60 million. So I'll come here and say 48%, 0.48 of 60 million. So that's 28.8 million. So let's put it there so that you also can see 48% of 60 million. Of 60 million. I think it's okay like this. Brilliant. 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 48% of 60 million. That is 28.8. How much is the direct cost? The direct cost involved is 44 million direct cost because the joint operation will take its own share. So that's how much is that? 48% of how much? 44 million. Good. So 48% of 44 million. Brilliant. 8% of 44 million. So I'll come here and say 48% of 44 million. So 21.2. So put minus in front so that it will show that it's put the jacket put into account format. So what our gross profit will likely be, other things being equal, our gross profit, other things being equal, we've not really added it to his own separate financial statement items. But let's assume this is all we have. His own gross profit would look this way. Just look this way. Would look this way. So the gross profit then would be just sum all of this. Then we have 7.68. 7.68. So now the other operating cost. You agree with me? That are other operating costs in the question. Operating cost of how much? 3 million. In line with IFRS 11, Abata will take his own 48% of that 3 million. So operating cost 3 million. Operating cost 3 million. Operating cost 3 million. If to come here and take how much? 48% of 3 million. Good. So come here, 0.48 times 3. That make it 1.44. So an expense, I put it in jacket. Brilliant. Then we have other expenses. We'll come to that later. We'll come to that later. Come to that later. So come to that. So this is what the consolidated statement of profit or loss of would be based on what is bringing from that his own 48% ownership interest in that natural gas station. So now don't forget that we said that if you look at the concluding part of the question, it said that the revenue and cost are receivable and payable. Receivable and payable. So receivable, this revenue becomes receivable here. So under current asset, so I'll come here, I'll have receivable. Receivable. Are you following? Receivable. And how much is that? That will be 28.8 million. So why the cost? The cost now that comprises operating and direct costs will make up the payable. The payable will make up the payable. And this comprises direct cost, direct cost, and other operating cost. Other operating cost. Good. So hope you're following. So we'll come here. And how much is that? About two of them. So I'm bringing the two together. So see what I'm going to do. I'll come here. This is the first one. Then I had this other one too. So they become payable. Payable that Abata will have to pay. They have to pay to the joint operations or pay to the other party because that's what the terms of the agreement specifies. So it becomes this way. The following current liabilities. Then here we have current assets. So current assets. Now what will be here? That natural gas station. So the natural gas station will come here. Natural gas station can come under plant. We can call it plant. Abi? So is your equipment? No, it's plant. Plant. Now he will take his own share of the assets. If you come here, what is the cost of the natural gas station? Natural gas station cost how much? 30 million. We'll take 48% of that 30 million. 48% of the 30 million. So 0.48 times 30 million. 48 times 30. So 0.48 times 30, that is 14.4. Oops, so that's the cost, 0.4. But then, we have to be careful. We have only looked at the cost of the natural gas station. Don't forget the asset was used for 1 year. So we have to account for depreciation from 1st January, can you see, 2018, and preparing the FS as I went, the 1st December. So we'll come here and allow for depreciation. Allow for depreciation. So he will take his own 14.4 million minus what's the figure for depreciation. Depreciation will now be that, the asset is to be spread over how many years? 15 years. 15 years. So we will now say 14.4 divided by 15. So I hope you are following. So if I divide 14.4 you're seeing here, divided by 15, will give me my annual depreciation. And I will now subtract it from 14.4 to get the answer. That's how to get this figure. So let's adjust for it here. So we'll come here and say 14.4 equal to 14.4 divided by 15. So per year, you're charging 0.96. So I will deduct this 0.96 from whatever answer I have here. So that will make the answer. So if you're following, good, brilliant. Oops, error. Oh, okay. Yeah. So 13.44. 13.44. 13.44. So, and then because we've charged depreciation now of 0.96, that is another expense. So come here, charge depreciation. Depreciation. And how much is the depreciation? 0.96. So come here, pick 0.96. And it's also an expense. 0.96. 0.96. So this is all what Abata PLC will bring in to his own financial statement from his ownership interest of 48%, the joint arrangement, that natural gas station. So is how it's going to look like. Consolidated statement of profit or loss, and then consolidated statement of financial position. Are you following? Good, good. So good. So this, so it's going to help. Maybe. So let's call it solution. Joint arrangement. Good. So I hope you are very clear with question 5. So move on quickly to question 6. Question 6 is saying, on 1st January 2011, entities A and B each acquired 30% of ordinary shares. Ordinary shares that carry voting right at general meeting of entity Z for 300,000, each of them 300,000. Entities A and B immediately agreed to share control over entity Z. So they had share control. For the year ended 31st December 2011, entity Z recognized a profit of 400,000. On December 2011, on 30th December 2011, entity Z declared and paid a dividend of 50,000 for the year 2011 at at 31 December 2011. So the fair value of each venturer's investment in entity Z is 425. However, there is no published price quotation for entity Z. So how do we recognize it? So what so how would you account for this transaction as requirements? So how would you account for these transactions? So of course there is a separate entity Z. That's a separate entity Z. Separate entity Z. So because there's a separate entity Z, this question is tending more towards joint venture. joint venture. And if it's a joint venture, IFRS 11, IFRS 11, IFRS 11 requires that. IFRS 11 requires that we equity, we equity account for it. So as provided for by IS 28. IS 28 is titled Investment in Associate. Investment in Associate. Investment in Associate. So this is good. So now let's use this opportunity to explain the concept of investment in associates. Investment in associate is saying that what you only do is take your interest and take your ownership and apply it in the net asset of that entity. The net asset sometimes could mean that after your interest, after you have acquired that interest in that entity, you look at the post acquisition profit, take your percentage of the post acquisition profit from the whole profit. If there is no dividend, then you take it home. If dividend has been declared and paid to you, it means that as you are applying your own ownership interest on the post acquisition profit, you are deducting that dividend. So whatever you have left now must now be added to the cost of your investment in that separate vehicle. So, and don't forget already, the moment you purchase that interest in that joint arrangement, you must have debited your investment under non-current asset. We call it investment in entities, so and so, and cash must have been credited. So that's the two leg. But when you are now equity accounting for subsequent years, accounting entries will play out this way. So if the additional profit made between last year and now is 100,000, and you have to take 20,000 from the 100,000, so the 20,000 will be added to the cost of the investment that you have in your FS, then so that the asset side can go up. So the profit that you are taking also will go to your statement of profit or loss, because that one will dovetail into retained earnings. Then your statement of financial position will be fine. So let us look at how this will work. So each of them, so we can just pick for maybe A or B. We've established we agreed that is a joint venture. Let's pick for A or B. So and what's the cost of the investment? 300,000 as the cost of the investment. The profit that was made after they acquired, don't forget they acquired it on when? 31st January. And for the year ended, the entity made what? A profit of how much? 400,000. 400,000. But on 30th December 2011, the entities declared and paid a dividend of 150 for the year ended. So at 31st December, the fair value of each of the venture entity is 425. However, there is no published price quotation for entity Z. So how would you account for this transaction? So let's look at this too. Promises to be interesting. Promises to be interesting. I'll show you how the thing will look like. How it will look like. So make it 12. Then I zoom it in. Okay, I think it's fine. So we'll prepare. What's the name of the entity? Let's just put for A. Say maybe now we for APLC now. APLC, PLC will show us consolidated statement of profit, statement of profit or loss, and it's for the year ended 31st December, 31st December, what year? 2011. So we do something similar, the statement of financial position. So here, so just come and bring in one line. Shares in share from joint venture. What's the joint venture? What's the name? Entity Z. Share from Z. So this share is share of profit. Share of profit from Z. Share of profit from Z. That's the only thing that we'll bring out here. If you come here, under investment, you have your asset this way. Have all your assets like this. All your assets will come here. Then under asset, you have non-current. Remember, non-current, non-current assets. Then under non-current assets, you have property, plant, and equipment. Equipment without S. So we have intangible. If there is any tangible, there's any. Then other non-current assets. This is where we're going to put that investment in associate. Others. So under these others is now come here and say what? Investment in associates. Investment in associates. Investment in associates. So also put our naira sign there. Are all the figures in millions? No, not millions. So we can still work with those figures that we have there. We can still work with them. Brilliant. So come here. Oh, good. So I'm bolding this. What's that's the title? So we'll come here. Oh, brilliant. Brilliant. So we are ready. So what will happen? So because we are equity accounting for it, what we are going to do is we will take 30% because in the book of A. So the initial thing that must have happened is this 300,000 will come here under other non-current asset, 300,000 for A. Don't forget we are in books of A. 300,000 will come in here. I hope you're following. 300,000 come in here, will come in here. Brilliant. That is before that profit. When the investment took place, that is what must have happened. So cash must have gone down before this investment will come in here. So cash will go down. Cash is under current assets. Cash gives, investment associated will take. So it's still the same asset. If you look at it under accounting equation, it will still balance. So now at the end of the year, what happened? We made a profit of what? Of how much? 400,000. So we'll take its own 30% of that 400,000. 30% of the 400,000. So come here and say 0.30 of the 400,000. So that becomes 120. So 30% of how much? Multiplied by 400,000. That makes it 120. Makes it 120. Makes it 120. Good. That is what you see here, 120. But don't forget that this amount is still going to go down to other comprehensive income at the end. Sorry, total comprehensive income. Total comprehensive income. You have forgotten the format for preparing financial statements. Line with IS1, it may as well be advised to go back and revise. So 120. So it's coming down and it's going to where? It's going to retain earnings. It's going to retain earnings. But now at the end, what now happened? There was a dividend of how much? 150,000 that was paid. So sorry, profit of 400,000. So you take the same amount. And how much do we take there? You can see. So 30% here is 120. So this 120 is going to increase our investment in our associates. So I will only come here and say this 300,000 that was there before. We are going to add what? We add 120,000 to it. So that makes our investment in associate to be what? To be 420,000. 420,000. Can you see? To be 420 to be 420,000. So, and we have not violated any double entry principle here. Look at what we have just done. We're bringing in 120,000. So, profit had taken in 120,000 and it's coming as an income. That's a credit entry. So, this investment in associate, which is an asset, has gone up by how much? 120,000. And this 120,000 is still going to come down under equity and liabilities. Under equity and liabilities. So particularly once we have equity, once we have equity, then under equity put the figure, then maybe ordinary share capital, and then we now come to retain what? Retained earnings. So that profit of 120,000 will be part of 120. So if you follow accounting equation very well, you'll find out that the asset side of the statement of financial position has gone up by 120. And the same has also happened to the equity and liability side. So the concluding part of the question now says that at 31st December 2011, the fair value of each venturer's investment in entity Z is 425,000. So the fair value of each is 25. So they did the fair value. Now, how much do you have? How much is your own value here? So 420, 420. So the fair value of each venturer's investment in entity Z, so of each is 420,000. And what is your home value? Your home value here is how much? 420,000. So, and if it means the fair value is higher, the cost of the investment is lower. So, I take you back to IS 38, which is on impairment, 36, which is on impairment. IS 36 says that impairment is the amount by which the carrying amount the carrying amount of an item of asset or liability exceeds its recoverable value. So recoverable value. So we are reporting 420, but the market is saying that that asset is what? Is worth how much? 425. So in line with prudency and in line with our 36, we have to stick to 420,000. So what that means is there is no, there is no, no what? There is no impairment, no need, there is no need for no evidence. There is no evidence that the asset, that the investment in associate, evidence in associate, in the entity what? What's that entity? Entity Z, in entity Z is impaired. So that's no need, is impaired. So let's go back to the solution once again. You can see is our final answer, consolidated. This is what we call equity accounting in line with IS 28. Hmm, This guy is flowing down, it's going to flow down, other things being equal, it will flow down here. Can you see? And this is what the statement of financial position would look like. So, with this, ladies and gentlemen, I think you have had an amazing time in class. So, thank you.